Welcome back to the BD Daily Finance News Podcast, daily insights on markets, economy, and investing. I'm your host, and today we're diving into rate cut fever. Gold going full drama queen above $4,200 an ounce, and AI trying to eat the power grid for breakfast.
And I'm your guest. If you woke up, some markets rallying, gold mooning, and your utility bill creeping up, and thought, is this fine? This episode is for you.
Today is 2025, December 4th, and we'll hit four big stories. 1. Global stocks climbing on hopes of a Federal Reserve rate cut. 2. Gold hovering around $4,200 an ounce after a big run. 3. Whether this rate cut rally is actually rational. And 4. How the AI data center boom could push up your power bill.
So basically, central banks, shiny metal, maybe bubbly stocks, and AI trying to set your toaster on fire. Perfect. Let's start with the rally before it disappears.
Story 1. European stocks are gaining. Asian markets are firm, and U.S. futures are up as traders bet the Fed will cut rates soon. One wrap-up put it simply. Optimism is building for a year-end rally powered by a coming rate cut after softer U.S. labor data.
Markets are basically saying the Fed will finally stop being the strict parent and start handing out allowance again. 1 week jobs report, and suddenly everyone's planning a party.
The logic is weaker labor data plus softer manufacturing numbers increase the odds of a cut. Lower rates mean cheaper borrowing for companies and households, which tends to support stock prices and risk assets into year-end.
It's like your credit card company suddenly slashing your interest rate. You feel richer, you spend more, and your favorite retailers look better on paper. Until, bills still exist.
Exactly. For investors, the key is that this rally is being driven by expectations, not actual policy yet. The Fed hasn't cut, markets are just pricing in a cut based on data and probabilities.
So it's like your boss hinting at a bonus in the holiday party speech. You haven't seen the money, but you already opened 5 tabs for vacations.
For a mid-career investor, the practical move isn't to chase every growth stock that pops on rate cut headlines. It's to ask, if the Fed cuts because the economy is slowing, are your holdings balanced between offense, like tech and small caps, and defense, like quality bonds and dividend payers?
Right, because if growth slows too much, that party playlist turns into a recession playlist. You don't want to be all in on hype stocks when the DJ pulls the plug.
One more nuanced stocks are also getting a lift from optimism around China and the Fed. A benchmark for emerging equities is heading toward a 2-week high as foreign investors tiptoe back into Chinese names.
So if you've got an emerging markets fund in your 401k that's been depressing you for 2 years, this is that moment where it texts you, "Hey, miss me?"
Just remember, those funds are volatile. For most people, emerging markets should be a slice of the pie, not the whole pie. Think 5 to 15% of equities, not a YOLO bet.
Action step here, log into your accounts this week. Check if your winners have grown way beyond your target. If your stock allocation is suddenly 80% because of this rally, maybe trim a bit instead of high-fiving your screen.
Let's pivot to story 2. One note we saw had bullion reclaiming the $4,200 per ounce handle, with a recent rally toward $4,240 driven by expectations of Fed cuts, weaker U.S. manufacturing data, and geopolitical risks, including tensions around Venezuela.
Gold heard the word uncertainty and said, "My time has come." But now it's pulling back to around $4,205 on profit-taking. Translation, some early buyers are cashing out and flexing.
The finance behind it is simple. When investors think rates will fall and the dollar may weaken, the opportunity cost of holding gold, an asset that pays no interest, goes down. Add geopolitical stress and gold becomes a kind of global anxiety barometer.
It's basically a financial, emotional support pet. It doesn't do tricks, it doesn't pay dividends, but you hug it when the world looks scary.
For normal investors, the question is, should you pile into gold at these levels? The answer is usually no piling. A small allocation, maybe 3 to 10% of a portfolio, spread across gold and other real assets, can hedge inflation and currency risk.
So don't sell your retirement index fund to buy a pirate chest. Think of gold like hot sauce. A little adds flavor. Too much, and you're just crying and regretting life choices.
The report also flagged a contrarian signal. A lot of retail traders are net long gold here. Historically, when the crowd is very one-sided, the next short-term move can be the opposite. So short-term traders should be careful about assuming a straight line to $4,300.
If your cousin at Thanksgiving and your barber are both bragging about gold, that's not a buy signal. That's a caution sign. Maybe you rebalance instead of joining the group chat late.
Actionable move. If gold ETFs or miners have ballooned beyond your target, take some profits and rotate into assets that lagged. If you have zero real assets, consider a small, disciplined allocation, not a FOMO trade.
And keep in mind, gold is a hedge, not a lottery ticket. If your retirement plan is gold goes to the moon, that's not a plan. That's fan fiction.
Story 3. One analysis called this a stock's irrational rate cut rally and tied it to the prospects of Kevin Hassett potentially becoming the next Fed chair, with betting markets putting his odds around 75% in some discussions.
So markets are partying like the Fed is about to become super dovish, while also stressing about who's going to run the party. Classic.
The concern some bond investors raised is that a politicized Fed chair could be more willing to cut rates aggressively under political pressure, even if inflation isn't fully tamed. That can juice markets short-term, but increase long-term volatility and inflation risk.
In normal people terms, it's like having a referee who really wants the home team to win. Fun if you're the home crowd, terrifying if you care about the integrity of the game.
For your portfolio, this means two things. First, rate-sensitive assets like growth stocks and long-duration bonds may keep swinging on every Fed headline. Second, you need to separate your long-term plan from short-term political drama.
So maybe don't rebuild your entire retirement around a prediction about who'll sit in a specific chair in Washington. That's not investing, that's sports betting with extra steps.
Exactly. Use this rally to stress test your risk. If a single Fed headline can move your net worth by 5% in a day, you're probably over-concentrated in high volatility names or leverage.
Action step, check your single stock positions. If one tech or meme name is more than, say, 10% of your investable assets, ask yourself, would I sleep if this dropped 50%? If the answer is no, maybe trim before the next Fed plot twist.
Story 4 is where macro meets your living room, the AI data center power boom. Analysts are warning that if the AI race turns into a bubble, families could end up stuck with higher electric bills after utilities overbuild power infrastructure.
So AI isn't just coming for your job, it's coming for your utility bill. Great. Can it at least negotiate my internet price while it's at it?
The setup is this. AI data centers need huge amounts of electricity. Utilities and grid operators plan multi-billion-dollar upgrades, new generation, transmission lines, substations. Those costs are often socialized across all ratepayers over decades.
Imagine your neighbor builds a massive crypto mining shed in the backyard, blows out the neighborhood transformer, and then everyone on the block has to chip in for the upgrade. That's the vibe.
From an investing angle, the report notes there's a short window where companies tied to power, utilities, grid equipment makers, certain real estate and infrastructure plays could see strong earnings from AI-driven demand.
So AI is like a very hungry roommate. Bad for the grocery bill, great if you own shares in the supermarket.
But if the AI boom cools and usage doesn't match the build-out, regulators may still let utilities recover costs through higher rates. That's where households get stuck paying for stranded or underused assets.
Which means your bill goes up even if you personally only use AI to ask, what should I make for dinner? Honestly, that's rude.
Practical moves. 1. If you're in a deregulated electricity market, it's a good time to learn how fixed-rate contracts work and lock in reasonable rates before big hikes. 2. On the investing side, look at diversified utility ETFs instead of chasing one flashy grid stock.
And 3, if you're career-minded, this is a giant neon sign that energy and grid engineering, data center design, and efficiency tech are growth fields. The AI gold rush needs electricians and engineers, not just coders.
Exactly. If you're mid-career and thinking of a pivot, a certification in energy management or cloud infrastructure could be more durable than chasing the latest AI app.
Plus, you get to tell people at parties, I keep the internet from melting the planet, which is a strong line.
Let's land this. Today we covered a global stock rally built on rate cut hopes, gold's run around $4,200 as a hedge with hype risk, the possibility that this is an irrational rate cut party, and AI's growing claim on the power grid and your utility bill.
1. Rebalance if this rally has blown up your risk. 2. Treat gold like seasoning, not the main dish. 3. Don't build your life plan around one potential Fed chair. And 4. Pay attention to your power bill and maybe own a slice of the companies sending it to you.
If you found this useful, follow the BD Daily Finance News podcast, share this episode with a friend who keeps saying the Fed's got this, and leave a question about your biggest money worry heading into 2026.
We'll be back tomorrow, turning more confusing headlines into something you can actually use. Until then, may your stocks be rational, your gold be modest, and your electricity bill not look like a tech company's.